Yeah, good morning, everyone. Thanks for joining in. Today we are going to talk about the markets and investing, share our thoughts on it. Since there's a lot of volatility in the market in terms of the markets are actually going up, not much going down. So there are a lot of questions and confusion about what to do at this point in time, given the valuations are also quite high. My name is Sumit, and I'm co-founder of Truemind Capital Services. During the session, if you have any questions, please type that in the chat box and we'll take all of them at the end of the session. So reversion to the mean is the iron rule of the financial markets. This is said by John C. Bogle. John Bogle is considered to be the father of index investing, index funds. He's a founder of Vanguard Mutual Fund, which is running the biggest index fund in the world, also popularly known as ETF. So he was the person who popularized ETF, actually, that we all are hearing of. And he said reversion to the mean is the iron rule of the financial markets. What does that actually mean? So simply it means that something which has gone much above the mean will go below the mean as well. So that in the long term, the median is maintained, the mean is maintained. The chart that I'm showing you is a chart of Nifty P ratio over a period of 23 years from 1999, another 22 years till now. And the P ratio, as you can see, has been fluctuating around its mean, which is 20 over a long period of time. And that's how, the mean is maintained. Before the IT bubble burst, the maximum P that Nifty went to was 28.47. After that, it crashed to roughly, 10, around 10, 11, which is a correction of 60 to 65% from the peak. It went up again, and during subprime, before subprime crisis came into realization, the P ratios were again at around 28. It crashed to 10, again a correction of roughly 60-65% from the peak. That means if you have a lakh invested, the value remains 35,000 at the bottom of the market. So these kind of market corrections, going to the peak and to the trough are very normal market behavior. This is usually how the markets work. But what we have seen over the last few years, 4-5 years, that markets have continued to remain above its median for a very long period of time. There's not much volatility. And the prime reason that can be attributed to it is the liquidity, which is being, the liquidity blast done by central banks all around the world, which actually started from 2008-9 onwards after the subprime crisis, when the quantitative easing started happening. And that lifted all the boats in the market. It reduced the market volatility on the downside. And whenever the markets started doing, making any, going through any correction, the central banks always scheduled the market and told the market participants that don't worry, we are ready to pump in more money as required. So what does that actually did, this attitude of central banks and ensuring market participants that there won't be much volatility on the downside, it didn't bring much volatility. And so market continued to remain higher than its long-term median. And during, so much of pumping of money, which resulted in expansion of balance sheet and reduction in interest rates, central banks thought that they actually should be reducing and normalizing it. But because of corona-related shutdowns, the market crashed within a short span of time. And to support the market again, they opened the floodgates of liquidity, which resulted in markets, the P ratio shooting up to even 42, which is much above its long-term average, 4 standard deviation from its long-term average, which was never seen in the last 25 years time frame. And although it has gone through some correction because of change in methodology of calculating the P ratio by Nifty, but still we are trading in a very high expensive zone, which eventually, will have to revert back to its mean. So this chart is all about, it's a heat map, which shows that, the P ratios were expensive and when they were cheap. The cheaper the P ratios are, the greener the color is. So as you can see, we had been in green zone for a very, very long period of time. We had started entering, white and red zone during IT bubble time here, during subprime crisis in 2007, 2008. And over the last few years, it has been mostly the red zone that we are into. For a very brief period of time in last year, it was March, April, and May when we were, in decent green zone, which we can also say a slightly fair valuation. But of late, we are trading at very, very high P ratios compared to the historical standards. So when I say that markets are at its peak, it's not only the numbers, the P ratios that define it. It's about the behavior of people also around us that validates that we are, in a zone where there is a lot of euphoria. There is a easy money easy money making happening, and people really do not bother about that markets can correct. As I have shown here, we have seen in the past 4-5 years, there is not much volatility on the downside. So this brings a lot of recency bias also. Recency bias is something, we are a lot of, we get a lot influenced by what happened in the recent past and not realizing, the real behavior of market is actually quite volatile. And we believe that the markets do not go much down, and there is not a possibility that it will go down by more than 10%, 20%, given our recent experience in the market. So that is a recency bias which many people actually are going through right now. They believe that market correction would be short-lived and it won't be, very high in quantum. So what behavior we are usually observing at the, during the market peaks? First is, retail participation is huge. People with very less knowledge about stocks and most risk-averse FD investors start putting money in equity markets. So even I have, we all are seeing that people right now, giving tips about stocks. Probably you would have observed those who never talked about equity or, very little talked about equity are quite active nowadays, talking about investments. You invest here, you invest in this stock, this will go up. So this is an attitude which even I am observing. So my college group, there is a WhatsApp group where, people talk about investment, and I see a lot of people who never talked about stocks, who were always, risk averse and put their money in FDs. They are giving stock tips now. So this kind of, amuses me, the kind of market behavior we are seeing, the participant behavior that we are seeing, that is quite interesting and, make me realize that, okay, we are, closer to the peak of the market. And many people also see that a very valid reason that FD's returns are obviously very low. So let's invest in equity. But one thing is, one need to really understand that equity market fundamentals are very different than debt market fundamentals. Equity is not an alternative to debt. You cannot think that, okay, if debt returns are less, let me put into equity. It cannot be an alternative. The fundamentals are entirely different. The equity actually goes through significant volatility. Your debt won't go negative if you're putting into FDs and safe debt mutual funds. It won't go negative, but equity can go down by 40 to 50%. Now, people do not believe that it is going to go down by 40 to 50%. Now, as I said, recency bias is, playing its role right now. So they think that, okay, if I put into equity, I'll end up, getting higher returns, and the downside, obviously, I don't think is going to happen. But this is not correct. We should not be, influenced by what happened in the last few years, but we need to look at the market from a longer perspective and understand the real nature of market is animal-like, very unpredictable, very volatile. But we are going through a phase which will correct. When it will correct, nobody knows. But I have some reasons which I'll discuss with you as we go forward. Second is newspaper headlines scream with euphoria about new peaks achieved by markets. So this, on the front page, this news, bull run, India's market cap hits 3 trillion. This was a news in this week, Economic Times only on the front page. And similar kind of news, right now is going through. People are actually, have mixed speculation and investing. There's no clear distinction between it. And similar kind of news we are hearing. We also are hearing that people are very much talking about cryptocurrency, which many people even do not understand. They know what fundamentals are driving cryptocurrencies, bitcoins, doggy coins, meme currencies are coming up. So this is something very much telling of the speculative behavior that we are seeing in the market, which is not really healthy as we go forward, because a lot of new people come in the market, market crashes, they learn their lesson, and those who learn their lesson and do not repeat the same mistake in the next cycle. So that's very important to understand what happened in the previous cycles and do not repeat those mistakes now. Third, there is an utter rejection, ridicule of thought or statement that markets can decline by more than 20%. So as I said earlier, this is something which many people think that markets cannot correct by much. Even if it does, central banks will come and rescue them. So even in this case, I think there is a limit to which central banks can really, continue to support the markets, although they say they will do whatever it takes. But there are certain things which, will happen. Even central banks will be helpless to, do anything in those situations. So we are talking, we have passed Corona situation, and we think that with vaccines, everything will be better. But there are so many unknowns and known unknowns, which can pop up at any point in time, and we really do not would be in a situation to handle it comfortably. Fourth is majority of the stocks start trading at the valuations much above their historical averages. As I showed, the entire market is trading at very high valuation. Even mid caps, small caps, and junk stocks, they have started trading, picking up, and the prices are shooting up, and everybody feels confident that they are picking the right stocks. Everybody wants to pick a multi-bagger right now, or something which will make them rich very quick. So this is a scenario, this is a behavior we are observing around us. Fifth is a melt-up rally, usually more than 50% from the lowest market level in the last 1 to 2 year period. So as we have seen in this chart, before the IT bubble burst, there had been a sharp upside move in the market, which is roughly about 120% from the bottom we saw earlier. So this 120% plus kind of an upside move, which happened in the span of 1.5 years itself. And before the subprime bubble burst, there was a sharp upside in the market, which was again around 115% and 10% within a 1 year period time frame. During this phase in the last few years, so we did not see, although the P ratios were higher before even COVID happened, there was no a sharp upside rally, melt-up rally of more than 50% in a short span of time. But this also has, this situation, this condition has been observed now from the March lows till now. The markets are up roughly 100%. So there's a sharp rally within a span of 1 year. So as a matter of fact, we are ticking all the 5 boxes here, which are the indicators during market peaks. So let's look at the expected returns from the current levels. So many people say that, irrespective of what levels we invest in, Nifty will ultimately go up, and our returns, would be higher over a longer period of time. But how much higher? This is something which one needs to understand. So I have an Excel sheet prepared just to showcase what could be the expected returns if we invest at these levels. Yes. So this is the sheet we internally use to evaluate the expected returns. Okay, yeah. To evaluate the expected returns, this is the sheet we internally use. So we have input P ratio for Sensex, which is 31, which can be easily seen from BSE India website. So here, when you click on bseindia.com, you click on S&P BSE Sensex. Here you see P ratio of 31.9. So if I put this here, 31.9, this is my current P ratio. And my intrinsic P, which I say is a long-term average, it's a median P. So I'm taking it as 20. So for current P to reach to its median P, the downside from for that re-rating of P ratio itself is about minus 37%. So ultimately, we will revert to mean. That is something we are very sure of at some point in time. And if we think that, okay, how this reverting to the mean affects my portfolio over, say, 3-year period, 4-year period, or 10-year period. So that is something we need to, I'm going to showcase you on the projected returns. So assuming that our long-term average Sensex companies returns is say 10%. So as a matter of fact, last 5-6 years, the returns have been in the range of 4 to 5%. I'm still taking it 10%, assuming that things will be much better going forward. So when I'm, assuming 10% returns on Sensex and also adjusting it for the high PE ratio, my next 3 years return on the index comes out to be minus 2.43%. My 5-year returns comes out to be 2.54%. My 10-year returns, here 10-year, comes out to be 6.27%. So that is the kind of returns we are expecting by having our investment exposure in equity market. I'm not saying that markets will start correcting, tomorrow or within a month. It could be the market can continue to remain high, but over a longer period of time, the expected returns from these levels are not good. So risk reward ratio is very much unfavorable at this point in time. Even I adjust, assuming that intrinsic PE, say, the markets continue to remain at higher PE for a longer period of time, instead of long-term median to be 20, let's take it 23. Then also, my 5-year returns are 4.42%. My 10-year returns on index are 7.21%. So this low returns, with a kind of downside we can face from the current levels. As I said, from the peak, markets could correct by 60 to 65%. The risk reward ratio is very unfavorable. So even next 10-year returns expected on indices is 7%, whereas the downside could be 60 to 65%. Now, if we are expecting, 12 to 15% from our equity, what should be the levels we should be investing at? So assuming, making it back to say 20 and current PE levels, I'm, adjusting to understand how I will arrive at 12 to 15% kind of a return. So if I put 25 here, then also my index returns of 6% over the 5-year period. If I say put 2018 here, then I'm in a position to get 12% returns over a 5-year period, assuming my expected returns are 10% on Sensex overall in the next 5-year period. If I'm taking it as, say, even 12% return over the next 5 years, then I'm seeing 14% return over a 5-year period, or 15% return, 16% over a 3-year period. So the levels which I'm talking about is 18p or 20p. So which means that for generating decent returns over a long period of time, we should be investing at decent levels. We cannot be investing at very high levels and assume that markets will still reward us with good returns. So I would like everyone to read this before I move to the next slide. So the line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, normally sensible people drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There is a problem though. They are dancing in a room in which the clocks have no hands. So anybody can guess who said this? They can type. You can type it in the chat box. Well, it was said by, okay, who has answered? Pawan Prasad, Warren Buffett. Yes, Pawan, you're right. It is said by Warren Buffett. So that is correct. And this was, this he said before the IT bubble. So when he did not participate in the tech stocks, during the IT boom that happened in 2000, he was ridiculed a lot for not participating in stocks which are going high. And everybody felt that he's old, his philosophy is useless. And, the new generation understands the market much better. And that is a time he said, and when the bubble burst, Warren Buffett was not affected much than all the other people who have heavily invested in tech stocks. So simply with this statement, he's trying to say that everybody may be realizing that markets are expensive, but still do not want to miss even 1%, 5%, 10% upside, which may happen in an expensive market. Nobody can really pick the top of the market, but one can really understand that we are, really in expensive zone. At any point in time, markets can correct if there is any unfavorable news that may come. So the timing when that will happen, from which level it will happen, nobody can calculate. So there has to be a framework one needs to follow to be able to reduce the downside and enhance the upside return, which I'll talk about later. So markets being expensive doesn't mean that it will start correcting on its own. There has to be a trigger for correction. So what could be those triggers which can result in bursting the market bubble? So as I've been saying that central banks all across the world have been pumping a lot of money. I've shown this chart in my previous presentation as well. So expansion in US Federal Reserve balance sheet, it started happening after subprime crisis, and it started, it continued for a very long period of time. They started reducing a bit of, normalizing the balance sheet size before the, this Corona incident happened. And then they again boosted their balance sheet multiple times. So from $4 trillion, it went up to $10.3 trillion in a short span of time, within a year actually. And the money printing that has happened in the US is, 21% of all US dollars were printed in 2020. So that's kind of money printing that has been happening on a very rapid pace. And interest rates also have crashed. So after subprime crisis, interest rates started rising from 2016. As I said, central banks were thinking to normalize their balance sheet and interest rate, because they felt that whenever there would be crisis, they won't be in a position to use the tools to again intervene in the market. But before they could have normalized it to decent levels, Corona happened, and they again cut down the interest rate to 0.25%. A lot of bonds, government bonds of say, Germany, Japan, they were trading at negative yields, which is something unprecedented. Nobody could have thought that the yields on bonds would be negative. The returns on bonds would be negative. You're holding it for say 10 years period also. So 18 trillion roughly bonds were trading in the negative yield just few months back. So why there's so much liquidity could cause a problem? So why central banks before 2008 did not infuse so much liquidity in the economy and helped, say, every sector, every person giving money to every person, which they are doing now. They're directly crediting bank account of their citizens. The prime reason was that they feared that inflation can rise and it can play havoc to their stabilization of the economies. So before that, whenever they thought of printing more money than the production, the rate of production in the economy, they always feared the price rise will happen, which is inflation. And this is not healthy for any economy. People actually see economy weakening when there's a high inflation. So we know all the examples of Zimbabwe, Venezuela. So all these countries have suffered high inflation and the economy is completely destabilized. So that's but after 2008, when they started printing a lot of money supporting the economies, they saw that the inflation didn't rise really. And the prime factors which I think are responsible are globalization. So the factories are there all across the world. Wherever you could find the cheap material, cheap goods, you end up giving order to those countries. So so that's how China gained a lot of prominence, because a lot of goods were coming cheaper from China, and the globalization played a significant role in reducing the overall prices over the last 10 to 12 years. But that story is also changing now. People with this corona incident, many people do not see China in a very positive light. And they feel that all the factories, all their manufacturing units should not be just there in China. They should be diversifying it across the world. And because there had been lockdowns all across the countries, and so once the lockdowns happen, the mining activity, the factories, many of the factories, many of oil exploration things, they come to halt, and it takes time for them to come back to the same level of capacity utilization. So now, since we are seeing the lockdowns are being lifted in US, in Europe, in UK, the demand has started jumping rapidly. We can say it's revenge buying, and also because a lot of money and a lot of saving happened to a lot of people during the lockdown. They are purchasing things. They are going out and spending on different goods and services. So that is resulting in upside in the prices. So the upside has been about 70 to 80%. Commodity price indices have gone up by 70 to 80%. So all the commodity, be it agri commodity, be it let me show you a chart again. So be it metal commodities, all are going up rapidly. So this is the commodity price index. It has gone up by 72% in 1 year time frame. Your diesel prices, gasoline, your coffee has gone up, natural gases have gone up. So wheat has gone up by 33%. So corn, which is sugar, which is used a lot, it has gone up by 56%. Palm oil, which is also used by many FMCG companies, it has gone up by 76%. Soybean has gone up, which is used as a feed for animal farms. And rubber, and then metal prices. So zinc has gone up, your main iron ore has gone up by 112%. Copper, which is primarily used in electric cars, it has gone up by 84%. So that's where the prices have started rising rapidly now. And this is something, a very known risk that can play out in bursting the bubble. So why is that so? Because since the inflation is rising, central banks will be forced to increase the interest rates on debt, or market will not be ready to pay the same interest rate on the debt, because they also have to match some returns with inflation. So that's where, when the interest rates on debt will be rising, overall correction in equity will start happening, because people will start moving their money to higher yielding debt from equity. So that could result in one of the important factor, which I think could result in market correction. But this may or may not happen. But there are some other unknown reasons, known unknowns and unknown unknowns. Like coronavirus was not the known, factor which could have crashed the market. There could be some other factors like geopolitical risk or any other, natural disaster or something, which could again, burst the bubble. One thing is for sure, we are trading at we are skating at a very thin ice, and whenever anything will happen, which will prick the narrative that is set in right now, that central banks will do whatever it takes, interest rates will remain low for a very long period of time. Anything that will disturb this narrative will result in a significant downfall in the market. And as a matter of fact, if you think that you'll be able to come out before it really happens, forget it. It never happens. You cannot catch hold of the peak of the market. So excessive liquidity at cheap rates creates risk of hyperinflation and economic destabilization. That's why when I think of what assets could actually protect us in case there is inflationary scenario, other than gold, I do not think much of other assets. So maybe commodity schemes, commodity stocks can also be a good hedge for inflation. But there is obviously cyclical risk in commodity stocks. So it could be very good bet. It also has high risk and high return kind of a probability right now. One can take some exposure there, but it will be bought with a lot of risk. So I think gold will still be a more better hedge against inflation, given that it is accepted all over the world as an alternative to currency. Since there is a lot of money printing happening, the value of currencies go down, the debasement of currency happen, and it happens against what? It happens against a currency gold, which was earlier being used as a peg against all the fiat currencies, all the currencies. So removing gold as the factor for currency printing, it was removed in 1971 only. Prior to that, gold was always the factor deciding how much money should be printed. So the production of gold was linked with the money printing. So I feel that 15 to 20% of everyone's portfolio should be in gold to hedge against hyperinflation risk. So what should be the investment strategy to deal with uncertainty, given that we cannot catch the top, we cannot catch the bottom of the market? It's simply, you should have a tactical asset allocation plan. I have discussed this multiple times in my blogs, in my presentation. I'll reiterate, just stick to the tactical asset allocation plan. Discipline is very important. So what does that say is whenever the markets are at fair valuation for it's a representation purpose for a medium risk profile investor. So 18 to 21 P ratio, one can have exposure in equity of 40 to 50% remaining in debt. And as the markets are correcting, one can start increasing equity exposure. And when the markets are going up, should start reducing equity exposure in a very disciplined manner. So if one has a plan and follows it with complete discipline, I can assure over a long term, your returns would be much better than someone who is hitting sixes or fours right now. So it's important that we should look at our investing as a test match and not as a T20, where we just have to hit all the time 6 and 4. It's about in a test match, you only hit 6 and 4 when the ball is in the right place. So you should just focus on the levels of the market. When the levels are comfortable, then go aggressive. So there are times when you have to just protect your portfolio from the downside. And there are times when you have to go very aggressively investing in equity to ensure that your long-term returns are really good. So that's where one has to just wait for the right time to come. Thank you everyone for joining in and listening to the entire presentation.